Listen up, because if you've got any money saved or invested in the Philippines, things are about to get really interesting. The rules of the game are changing, thanks to a brand new law. And don't worry, we're going to break down exactly what this means for your money right here, right now.
And that's really the big question, isn't it? Because, look, it doesn't matter if you're a day trader, someone with a 5-year time deposit, or you just have a mutual fund. This one single law is basically rewriting the rulebook for all of us.
So what is this thing? Well, its official name is the Capital Markets Efficiency Promotion Act. Yeah, it's a mouthful. That's why everyone's just calling it CMEPA. It sounds kind of complex, but trust me, we're going to make it super simple.
Okay, so let's dive in. What is CPAP, really? You can think of it like this. It's a total makeover for how taxes work on your personal finances. The government is basically trying to tear down this old, super confusing system and build something fresh, simple, and way more modern for all of us.
Yeah, at its heart, the goal is pretty clear. They want a tax system that's simple, fair, and competitive. Simple, so you don't need a PhD to figure it out. Fair, so it doesn't favor one investment over another. And competitive, so we can go head-to-head with places like Singapore and Thailand. It's all about making the Philippines the place to put your money.
But you might be asking, why now? What's the big idea? Well, like any huge piece of legislation, CMPEPA has a clear vision. And it's basically taking aim at all the complicated stuff that's made our financial world feel like a confusing maze for, well, forever.
And the strategy behind it? It's kind of like a domino effect. First, you simplify the tax system. That hopefully gets more people like you and me to invest our savings. And when more of us invest, there's a bigger pot of money available for businesses that need capital to grow. Then, when businesses are thriving, the whole country suddenly looks a lot more attractive to investors from all over the region. See? One thing leads to the next.
And hey, don't just take my word for it. This isn't some hidden detail. It's written right there, front and center in the law's declaration of policy. It says the goal is to simplify an otherwise complex tax system for easy compliance. I mean, it doesn't get much clearer than that.
Okay, so that's the big picture. But let's be real, you want to know how this actually affects your money, right? Let's get down to the nitty-gritty, the before and after. All right, first up, and this one is huge for anyone in the stock market. The stock transaction tax, that's the tax you pay every time you sell a stock, is getting absolutely slashed. It's going from 0.6% all the way down to 0.1%. I mean, if you're an active trader, this is a total game changer. It's going to be so much cheaper to trade.
Just let that sink in for a second. 0.1%. This isn't just some random number they picked out of a hat. No, this is a calculated move. The idea is to fire up trading activity and make our stock exchange just as competitive, if not more competitive, than our neighbors.
Okay, but it's not all tax cuts. There's a big trade-off here. For a long time, if you were a conservative saver with a long-term peso deposit, we're talking 5 years or more, the interest you earned was completely tax-free. It was a sweet deal. Well, under CMEPA, that deal is off the table. That interest is now going to be hit with a 20% final tax.
And we're seeing the same thing happen with foreign currency accounts, or FCDUs. The tax on that interest is also going up to 20%. Now, this might seem rough, but it perfectly shows one of the law's main goals, to standardize everything. They want one single simple tax rate for as many different kinds of passive income as possible.
All right, so we've talked stocks, we've talked bank deposits. But what about other stuff? What if you're invested in things like unit investment trust funds, or UITFs? How does CMPA shake things up for them? Let's take a look.
And here is some seriously good news, especially for UTF investors. You know that annoying little tax called the documentary stamp tax, or DST? The one that got tacked onto your transactions? Well, CMEPA gets rid of it. Completely. That means investing in these funds just got simpler and cheaper. More of your money's actually invested, not just paid in taxes. That's a huge win.
Okay, so my head is spinning with all these changes. I'm sure you're thinking the same thing. When does all this kick in, and what about the money I already have invested? Great questions. Let's talk timeline.
So the timeline is pretty straightforward. The law was signed on May 29, 2025, and all these new rules officially kick in on July 1st, 2025. But here's the most important part, the question on everyone's mind. What about my existing investments? Don't worry, the government thought of that, and there's a crucial rule in place.
It's something called a transitory provision, and basically, it's your safety net.
It means that any investment you made before July 1st gets to keep its original tax rules for its entire life. So that 5-year tax-exempt time deposit you opened last year, it stays tax-exempt until it matures. Simple as that. The new rules only apply to new money invested from July 1st onwards.
Which, of course, brings us to the million-dollar question, or maybe the billion-dollar question. This whole law, CMEPA, it's a huge gamble. It's a bet that by making things cheaper for traders and simpler for savers, we can kickstart a whole new age of investment in the Philippines. So, will it work? Will this actually turn the Philippines into the region's next big investment hotspot, or are we just shuffling the deck, creating a new set of winners and losers in the same old game? Only time will tell.